thoughtfully delivering value and interpreting great books from around the world. Hi, this is Sally's Book Talk. Today, I'll interpret for you a book called The King of Capital, which is a biography of Blackstone Group, the king of the acquisition industry. In 2007, China's sovereign wealth fund invested in Blackstone Group, bringing the name Blackstone into the view of the general Chinese public for the first time. And in 2020, the news that Blackstone Group planned to acquire Chinese real estate company SOHO made it frequently appear in Chinese media again. So, what kind of company is Blackstone? Today's book will tell you the answer. It fully documents Blackstone's journey from startup to IPO, revealing how it started with $400,000 and grew into a private equity giant managing $200 billion. The book also deeply analyzes Blackstone's investment strategies, how its acquisitions, often worth billions or tens of billions of dollars, are completed. The author of this book, David Carey, is a contributor and journalist for Fortune magazine and other media, with over 20 years of experience reporting on the private equity industry. The translator of the Chinese version is Professor Ba Shusum, chief economist of the China Banking Association. Blackstone's development history before its IPO can be divided into 3 stages. The first stage, Blackstone seized the boom in the acquisition industry in the 1980s and successfully launched its business. The second stage, in the 1990s, the industry situation was complex and volatile, with initial decline and later new economy shocks, but Blackstone, through cautious and flexible management and business innovation, successfully rose to the top tier. The third stage, after 2003, the U.S. economy began a new round of prosperity. Blackstone accurately judged this trend, went all out, completed many excellent deals, and with huge success in real estate, established its position as an acquisition giant. Next, I'll interpret each stage's journey for you separately. Finally, I'll also briefly introduce Blackstone's IPO process for you. First, let's talk about the first stage, acquisitions, which is buying and selling companies, an old business. In the 1950s and 1960s, the U.S. experienced a wave of acquisitions, generally initiated by industrial companies. Wall Street investors only played advisory roles, and such acquisitions were mostly paid in full with cash and stock. In the 1970s, a new model emerged in the acquisition market, leveraged buyouts, where the principle is like buying a house with a loan. The buyer pays a down payment and uses loans to acquire other companies. And in this new setup, loans act like leverage, letting buyers swing big deals with small capital. Back then, down payments for leveraged buyouts were lower than today's mortgages, high as 30%, low as 5 to 10%, with leverage ratios up to 20 times. Wake up. At first, leveraged buyouts were just small-time stuff. Not many paid attention. In 1978, a listed company, Udale, was snatched up for $380 million in one go, and the buyer, KKR, was a little-known small investment firm with little capital, relying on loan leverage. The Udale acquisition was the first large leverage deal led by an investment firm, instantly sparking interest among Wall Street folks. They were all asking around how KKR actually pulled it off, including Blackstone's founders. Blackstone had 2 founders, both at investment banking giant Lehman Brothers then. One was Peter Peterson, Lehman's CEO, and the other was Steve Schwarzman, was Lehman's M&A partner, and he was super keen on leveraged buyouts. After digging in, he quickly got the hang of it.
Companies like KKR are essentially private equity funds. They raise money from other financial institutions, which buy KKR's fund shares and hand over cash for investment.
KKR uses that money as a down payment for leveraged buyouts. After a successful buy, they look to sell the company off later. With big leverage in play, the profit from buying and selling turns out super lucrative. As the fund manager, KKR takes management fees and a profit share, up to 20%. Wow, this is a high return gig. If the deal makes money, KKR bags a huge cut. Even if not, the management fees a solid income. Partners at private equity firms, like Henry Kravis at KKR, earn several times what Wall Street banking CEOs make yearly. Schwartzman was pumped about this and started pushing Lehman to do leveraged buyouts too. Peterson got intrigued. But Lehman was tangled in internal power struggles and securities losses then, unable to join the game. Peterson poured most of his energy into saving Lehman. During that time, Schwartzman backed Peterson up, laying a deep friendship foundation for their future teamwork. By 1985, Lehman had weathered the crisis, and Peterson and Schwartzman finally decided to start their own venture and dive into the leveraged buyouts they'd long dreamed of. They named their new firm Blackstone, drawing from both their names. Schwartzman is of German Jewish descent. His name means black in German, while Peterson is of Greek origin, with his name meaning stone in Greek. On October 1st, 1985, Blackstone officially launched, facing two immediate tasks. First, raising capital for their acquisition fund. Second, getting operations underway.
Let's start with the first task. Peterson and Schwartzman initially aimed to raise $1 billion for a big splash.
But Blackstone was a bit late to the game. KKR, once unknown, had become the market leader by then.
Plus, Wall Street giants like First Boston and Morgan Stanley had already jumped in.
Oh, and a bunch of small private equity firms were popping up all over Wall Street, too. The bar for leveraged buyouts had risen. To get investor money, firms needed solid track records. Well, on that front, both Peterson and Schwartzman were novices. Peterson excelled at management but was pretty green in finance. Though Schwartzman was an M&A expert, he'd only done advisory work at Lehman with no hands-on deal experience. So Blackstone hit wall after wall in its first year. Once, when pitching to MIT's endowment fund, they got completely stood up. No one showed up to meet them. A downpour started. They had no umbrellas and couldn't get a cab. The two bankers had to beg strangers at intersections to share rides. Utterly humiliating. That's when Peterson's connections and influence made all the difference. Peterson had navigated the business world for years, later joining Nixon's cabinet as Commerce Secretary, rubbing shoulders with top U.S. business and political figures. When starting Blackstone, Peterson had been too reserved to reach out. But now, he couldn't wait on old friends any longer. Peterson approached the former head of British Bouchang's U.S. division, a longtime friend. Though retired, the new manager was his protege. Leveraging that tie, Peterson and Schwartzman landed $100 million over lunch, finally securing huge funding after a year of struggle. The founders were ecstatic. Peterson later recalled that meal as the most crucial milestone in Blackstone's history. Bouchang gave Blackstone not just financial backing, but more importantly, industry validation. Bouchang was a veteran player in acquisitions and the major backer behind KKR, the industry leader. Now, with Bouchang's vote of confidence, Blackstone essentially got its industry membership card. Next, Peterson's influence secured even larger funding for Blackstone. In April 1987, with First Boston Bank as matchmaker, Blackstone was formally introduced to Japanese financial groups. Japan's economy was then at its zenith, with the yen's appreciation massively boosting purchasing power. Japanese groups had just one thought about any U.S. asset: buy. Oh, when a Wall Street firm Bouchang-backed, led by ex-Commerce Secretary, with Lehman DNA, appeared before them, it instantly became prime target. When Peterson arrived in Tokyo, two financial groups even competed to court him. After just a brief Japan trip, they happily returned with $175 million. By 1988, Blackstone had raised $850 million total, the industry's largest first-time fundraising then. Now that we've covered fundraising, let's see how Blackstone's business began. Blackstone's first income was $50,000 earned in early 1986 from an M&A advisory deal. and Schwartzman's old expertise. Since funds weren't raised yet, Blackstone relied on advisory work to stay afloat. While fundraising, the advisory business gradually gained momentum too. By 1988, they'd closed 2 major deals, earning $15 million. Though acquisition funds were secured, they kept advisory as foundational work. Peterson and Schwartzman valued this income for deeper reasons. They wanted advisory work to connect with entrepreneurs and scout acquisition targets. Blackstone's first acquisition deal came through an advisory relationship. At the time, U.S. Steel faced a hostile takeover. Simply put, U.S. Steel didn't consent, but the buyer forced it, commonly called a hostile takeover. If successful, existing management would be ousted.
So U.S. Steel's management panicked. They planned to sell assets and use proceeds for stock buybacks to block the takeover.
Specifically, they wanted to sell their railroad transport business. But there was a conflict. U.S. Steel hoped to offload over 50% of shares while keeping control. To this, Blackstone proposed a win-win solution. Jointly create a company with U.S. Steel called Transport Star. The new company would then buy U.S. Steel's transport division through leveraged buyout. In the new setup, Blackstone held 51% shares versus U.S. Steel's 49%, but both had equal voting rights. This satisfied U.S. Steel's needs, but could the acquisition actually turn profit? In leveraged buyouts, Blackstone didn't directly take loans. Transport Star used the acquired transport division as collateral to secure financing. For this deal, Transport Star took on $500 million in debt. Steel being cyclical, if downturn hit, could transport earnings cover repayments? If Transport Star collapsed, everything would be lost, like drawing water with a bamboo basket.
Here, Blackstone showed true expertise. They built a financial model using industry data.
The model showed steel volatility mainly affected prices and profits, not output volume, and transport revenue tied to volume, so fluctuations were milder. Calculations proved even at 20-year low steel capacity, transport could break even. Now confident, Blackstone faced the next challenge: finding lenders. Many banks rejected cyclical industry deals. Schwartzman contacted nearly every New York bank. Only J.P. Morgan and Chemical Bank showed interest. Chemical Bank, then America's 6th largest, offered better terms. Blackstone finally secured loans from Chemical Bank. In this deal, Blackstone maxed leverage, investing just 2% of total capital. Within 2 years, dividends earned Blackstone 4 times returns. Finally, selling the company to a Canadian firm brought 25 times profits. Transport Star's success cemented Blackstone's foothold in leveraged buyouts. This deal had 3 special values. First, it achieved a groundbreaking 0-1 breakthrough. Peterson and Schwartzman finally had their own deal record, and a stunningly profitable one at that, proving to Wall Street they were top experts in the field. Second, they found a trusted long-term partner. Chemical Bank. For years after, Chemical Bank remained Blackstone's key lender, never financing competitors, forging an unbreakable alliance where both thrived together. Chemical Bank later evolved into today's renowned J.P. Morgan Chase.
Lastly, and more notably, this deal built Blackstone's positive image as a friendly, cooperative acquirer.
Back then, many private equity firms were called barbarians at the gate, treating acquired companies and management harshly, angering the business world and tarnishing the industry's image. In contrast, Blackstone acted with goodwill, collaborating with management, generously sacrificing some gains to meet their needs. Peterson even coined a slogan, "Be the operational problem solver for companies." A masterstroke move. Blackstone saw further than peers. Whether Blackstone or others, they all mastered finance, but knew little about actual operations. When starting Blackstone, Peterson was too reserved to reach out. Now, he couldn't keep old friends waiting any longer. Peterson approached the ex-head of British Baochang's U.S. arm, a longtime friend. Though retired, the new manager was his protege. Leveraging that tie, Peterson and Schwartzman landed $100 million over lunch. Finally, securing huge funding after a year of struggle. The founders were thrilled. Peterson later called that meal Blackstone's most pivotal milestone.
Baocheng gave Blackstone not just funds, but crucially, industry endorsement.
Baocheng was an acquisition veteran and the major backer behind KKR, the industry leader.
With Baocheng's vote of trust, Blackstone essentially got its industry membership card.
Next, Peterson's influence secured even larger funding for Blackstone. In April 1987, with First Boston Bank as matchmaker, Blackstone was formally introduced to Japanese financial groups.
Japan's economy was booming then, with the yen's surge massively boosting purchasing power. Japanese groups had just one thought about any U.S. asset: buy.
Oh, when a Wall Street firm, Baocheng back, ex-commerce secretary led, with Lehman roots, appeared before them, it instantly became prime target.
When Peterson arrived in Tokyo, two financial groups even competed to court him.
After just a brief Japan trip, they happily returned with $175 million.
By 1988, Blackstone had raised $850 million total, the industry's largest first-time fundraising then. Now that we've covered fundraising, let's see how Blackstone's business began. Blackstone's first income was $50,000 earned in early 1986 from an M&A advisory deal. Schwarzman's old expertise. Since funds weren't raised yet, Blackstone relied on advisory work to stay afloat, while fundraising the advisory business gradually gained momentum too. By 1988, they'd closed two major deals, earning $15 million. Though acquisition funds were secured, they kept advisory as foundational work. Peterson and Schwarzman valued this income for deeper reasons. They wanted advisory work to connect with entrepreneurs and scout acquisition targets. Blackstone's first acquisition deal came through an advisory relationship.
At the time, U.S. Steel faced a hostile takeover, meaning U.S. Steel didn't consent, but the buyer forced the purchase. If successful, existing management would be ousted.
So, U.S. Steel's management panicked. They planned asset sales to fund stock buybacks and block the takeover.
Specifically, they wanted to sell their railroad business, but faced a dilemma: sell over 50% shares, yet retain control. To this, Blackstone proposed a win-win solution: jointly create Transport Star with U.S. Steel. Then, the new company acquired U.S. Steel's transport division through leverage buyout. In the new setup, Blackstone held 51% shares versus U.S. Steel's 49%, but both had equal voting rights. This satisfied U.S. Steel's needs, but could the acquisition actually turn profit? In leveraged buyouts, Blackstone didn't directly take loans. Transport Star used the acquired transport division as collateral to secure financing. For this deal, Transport Star took on $500 million in debt. Steel being cyclical, if downturn hit, could transport earnings cover repayments? If Transport Star collapsed, everything would be lost, like drawing water with a bamboo basket. Here, Blackstone showed true expertise. They built a financial model using industry data. The model showed steel volatility mainly affected prices and profits, not output volume, and transport revenue tied to volume, so fluctuations were milder. Now, calculations proved even at 20-year low steel capacity, transport could break even. Now confident, Blackstone faced the next challenge: finding lenders. Many banks rejected cyclical industry deals. Schwarzman contacted nearly every New York bank. Only J.P. Morgan and Chemical Bank showed interest. Chemical Bank, then America's sixth largest, offered better terms. Blackstone finally secured loans from Chemical Bank.
In this deal, Blackstone maxed leverage, investing just 2% of total capital.
Within 2 years, dividends earned Blackstone 4 times returns. Finally, selling the company to a Canadian firm brought 25 times profits. Transport Star's success cemented Blackstone's foothold in leveraged buyouts. Oh, this deal had 3 special values. First, it achieved a groundbreaking 0-to-1 breakthrough. Peterson and Schwarzman finally had their own deal record, and a stunningly profitable one at that, proving to Wall Street they were top experts in the field. Second, they found a trusted long-term partner.
Chemical Bank!
Over the next few years, Chemical Bank remained Blackstone's key lender, never financing competitors, forging an unbreakable alliance where both thrived together. Chemical Bank later evolved into today's renowned J.P. Morgan Chase. Most notably, this deal established Blackstone's image as a friendly, cooperative acquirer. Back then, many private equity firms were called barbarians at the gate, treating acquired companies and management aggressively, angering the business world and tarnishing the industry's image. In contrast, Blackstone acted with goodwill, collaborating with management, sacrificing gains to meet their needs.
Oh, Peterson even coined the slogan, "Be operational problem solvers for companies." A brilliant strategic move.
Blackstone saw further than peers. All knew finance but lacked operational expertise. Building relationships with executives meant deeper understanding of true company value. For example, without U.S. Steel's data in the Transport Star deal, Blackstone couldn't have made accurate judgments. Ultimately, Blackstone made its mark overnight. U.S. Steel became its golden advertisement. Remember, U.S. Steel wasn't minor. Its predecessor was Carnegie Steel, founded by tycoon Andrew Carnegie, a household name in America.
With this successful case, Blackstone won continuous business streams.
All right, that concludes Blackstone's first phase journey. Next, how did Blackstone rise to the industry's top tier during the volatile 90s?
Starting in 1989, debt crisis erupted. Junk bond markets shrank by 90%.
Previously, firms like KKR sourced leverage loans from junk bonds. This turmoil ended the 80s LBO frenzy. Newly established Blackstone suffered consecutive failures. In the Edgecon Corp acquisition, Blackstone lost $32.05, enraging investors who blasted Schwarzman as a total idiot. Morale was low inside Blackstone, but they survived. Staying alive meant victory when peers were collapsing. For a new, shallow-rooted firm, this was impressive, all thanks to superb risk control. First, Blackstone diversified investments, never committing too much capital per deal. Pre-1989, they invested $60 million per deal on average. From 1990 to 1991, it dropped to $30 million, so even consecutive losses didn't cripple them. Now, second, Schwarzman realized earlier than peers that acquisition prices kept climbing throughout the 80s. In such markets, you had to build safety margins into deals. In some acquisitions, Schwarzman even surrendered potential profits. He made partners sign downside protection agreements, once mocked by Wall Street peers who believed deals meant taking risks for profits. Well, this guy won't take risks. Total coward, they sneered. But hindsight proved Schwarzman right. His caution saved Blackstone from its riskiest near disaster. That deal involved a bond interest rate reset agreement. It stipulated that if bond prices fell after a year, interest rates would rise accordingly. But Schwarzman insisted on a cap, fearing rates could skyrocket if prices crashed. And his fears materialized. Bond prices plummeted, but the cap saved Blackstone from $70 million losses.
Around the same time, KKR faced identical issues acquiring R.J. Reynolds Tobacco.
But KKR, less cautious, set no rate cap. Interest surged to 25%, costing them $700 million in one deal. Beyond risk control, Blackstone's early 90s stability also came from diversification. As mentioned earlier, besides core LBOs, advisory work provided steady income and pivoted to bankruptcies during recession. But Blackstone wasn't satisfied. It launched 3 stellar new ventures: bond investment funds, hedge funds, and real estate funds, all hugely successful, especially bond investments. Eventually, it spun off from Blackstone to become the renowned BlackRock Group, now the world's largest listed asset manager, overseeing over $3 trillion in assets. The secret behind Blackstone's exceptional diversification? Its talent strategy. Peterson and Schwarzman always believed, recruit only top-tier investors.
So they designed a revolutionary model: branch partnerships with 50-50 equity splits.
For example, real estate fund chief Schreiber and team got 50% ownership. Schreiber even lived in another city,
contracted to work just 40 days yearly. With diversified businesses shielding it, Blackstone overtook rivals during the early 90s downturn. From 1992, LBO markets warmed up. Blackstone's deal scale reached new heights. Most impactful was the $1.02 buyout of UCAR, world's largest graphite electrode producer. Here, Chemical Bank offered unprecedented support. Blackstone invested $187 million itself.
About a year later, Blackstone took UCAR public, earning $670 million.
UCAR's success helped Blackstone's third fund raise $4 billion in 1997.
Another record-breaking fund, but the joy didn't last long.
Blackstone sensed the acquisition industry cooling again. An unprecedented new economy wave was sweeping America. Tech companies, computers, and internet took center stage in capital markets. In late 90s, dazzling tech IPOs made venture capitalists fortunes. Some funds gained 300% yearly. Blackstone and peers almost entirely missed this new economy feast. They stayed in traditional sectors. Honestly, Blackstone missing this wave made sense. New economy investing differed totally from traditional LBOs. Leveraged buyouts focus on whether a company's income can support loans and if there's room to boost its value, requiring accurate judgment. This relies on financial analysis, Blackstone's expertise. While the new economy cares about trends and growth rates, many startups have little to no cash flow. So how do you gauge their worth? Blackstone's methods became useless, and it seemed doomed to miss this historic chance. Oh, just then, Blackstone happened to own a company that suddenly rode the new economy wave. That company was TV Premium Cable, bought by Blackstone from Time Warner Group. Back then, many believed satellites would replace cable networks. But Blackstone partner Gallagher saw cable firms had stable, undervalued cash flows, so he bought. Originally, this was just a routine deal. But with the internet boom, people realized cable networks could be tweaked to carry data. With that edge, cable companies became linchpins in network applications.
Spotting this, Blackstone snapped up Time Warner's other cable systems, plus 2 more firms.
They also acquired a mobile operator. Soon all these companies' values skyrocketed. Later, Blackstone sold the whole batch, netting $15 billion total. Blackstone caught the last bus and feasted on the new economy's big cake. Why last bus? Because the new economy bubble popped fast. In March 2000, NASDAQ peaked, then crashed, down nearly 80% by 2002. Some once hot tech firms saw market caps shrink 99%.
For Blackstone's peers, this was a second blow.
Those firms caved to investor pressure, diving into new sectors before the burst, getting buried at peak prices. In 2001, 62 big PE firms went bankrupt. 2002 added 46 more. Blackstone took hits too. Its acquisitions from 2000 to 2002 all flopped.
But thanks to huge cable and telecom profits, Blackstone still emerged as one of the era's biggest winners.
All right, that wraps up the second stage. Next, the third stage, how Blackstone grew into a private equity giant during the post-2003 boom. First, let's examine internal changes at Blackstone. Early on, Peterson and Schwarzman co-managed, with Peterson leading. He made huge contributions to fundraising and deal-making. But once established, Peterson gradually withdrew from management and reduced his stake. Schwarzman became Blackstone's true leader and soul. Schwarzman was 21 years younger than Peterson. A tireless engine, they called him. He worked 14-hour days minimum, emailed at 5:30 a.m., called constantly on weekends.
He single-handedly ran daily operations.
As business scaled, Schwarzman realized he needed not just great staff, but a perfect partner. Like his original partnership with Peterson, from 2000, Schwarzman searched, finally finding Tony James in 2002. James headed acquisitions at DLJ Securities, exceptionally skilled. His arrival drove Blackstone's transformation into standardized management. Before, Blackstone was freewheeling and personality-driven, lacking discipline, as staff put it. A cluster of mom-and-pop shops, partners operated independently. Sometimes leadership didn't know what projects partners pursued. No strict review system. Analyses were loose. James restructured Blackstone's org chart and implemented investment processes, laying foundations for explosive growth. In 2003, the U.S. economy hit an inflection point, starting a new boom cycle.
Schwarzman and James had predicted this trend in 2002. They refocused on LBOs, targeting cyclical industries.
From 2003 to 2007, Blackstone struck globally, landing major deals in autos, chemicals, energy, electronics. Key deals included a $4.06 auto parts acquisition, $3.04 for German chemical firm Celanese, and an $18.08 joint buyout of Freescale Semiconductor. You might wonder, didn't we say traditional cyclical industries were outdated? Why is Blackstone diving back in now? Because around 2003, right after the U.S. recession, cyclical industries hit rock bottom profitability. That meant those companies were at their cheapest valuations, prime for buying. As the economy recovered, their income and profits grew, lifting valuations too. This created double-barreled profits for acquisitions. Let's examine Blackstone's Celanese deal. You'll see the magic. Celanese, a chemical firm, had just $700 million cash flow in 2003. Blackstone bought it at 5 times cash flow, $3.05. In 2005, Blackstone relisted Celanese in the U.S., selling shares gradually. During this period, industry recovery boosted Celanese's sales and prices. Cash flow jumped 80%, while valuation multiples rose 1.4 times to 6.4 times cash flow. Cash flow and valuation growth together tripled the company's value in no time.
Blackstone netted $2.09 profit from this single deal.
Though Blackstone touted operational improvements, partners admitted 2/3 of gains came from economic cycles. Of course, during the 2003 to 2007 boom, Blackstone's most impactful plays were in real estate.
In 2006, after 2 mid-sized successes, Blackstone planned its biggest ever deal, acquiring Equity Office Properties Trust. Negotiations dragged 3 months.
Finally, in February 2007, Blackstone bought EOP for $38.07, a textbook perfect acquisition.
Oh, during the acquisition planning, Blackstone's team was super tense. A massive deal like this couldn't afford mistakes. How to ensure profit while minimizing risk?
They identified 2 key solutions. First, financial analysis revealed Equity Office Properties had core assets but was dragged down by mediocre ones. Say core assets worth $5 billion, others $8 billion, but combined valued at just $10 billion. That's $3 billion undervalued right there. With this insight, Blackstone's strategy was split assets, sell the mediocre ones to repay loans, then hold prime assets cheaply. By calculating value gains from this split, they locked in profitable acquisition pricing. Second, holding huge assets longer meant more risk. Swift resale was safest.
So how fast could they move?
Blackstone went all out. They started hunting buyers during negotiations. When signing the deal, they already had contracts with 2 buyers lined up. Ultimately, selling mediocre assets netted $3.5 billion profit while keeping prime urban offices, acquiring Equity Office Properties. This mega success boosted Blackstone's global fame and set the stage for its IPO. That concludes Stage 3. Finally, Blackstone's IPO story. The IPO plan began in 2006. Schwarzman wanted listing for 2 reasons. First, founder wealth liquidity. Second, IPO would enhance competitive edge. They could use stock for acquisitions or mergers. But IPO complexity was staggering. Blackstone was a federation of companies, funds, and 100-plus partners bound by intricate contracts. Plus, converting partner shares across funds into stock, tax avoidance, and preventing diluted control all needed solving.
Citigroup and Morgan Stanley's underwriting departments spent 6 months finally resolving,
these issues. Only one task remained: pricing. Determining Blackstone's true worth. To maximize share pricing, Schwarzman orchestrated promotional campaigns, magazine covers, TV interviews to boost exposure.
His most powerful move, publicly flaunting wealth.
He threw a $3 million NYC birthday bash. Business elites, Politicians, celebrities performing, all invited.
The publicity worked perfectly. Media frenzy even reached mainstream audiences, showcasing Schwarzman's wealth and Blackstone's success.
During this, Blackstone got two unexpected boosts. First, another PE firm went public before Blackstone.
Its stock doubled on day one, fueling investor hype and lifting Blackstone's potential pricing.
Second, through ex-Hong Kong Finance Secretary Anthony Leung's connections, China's sovereign fund pledged $3 billion, originally targeting $4 billion. This meant 75% more capital raised.
Finally, on June 22, 2007, Blackstone IPO'd at $31 per share, peaked at $38 that day, hitting $38 billion valuation, delivering staggering partner wealth.
Founder Peterson cashed out $1.09.
Schwarzman took $684 million cash,
retaining $9.04 in equity. Hindsight shows Blackstone timed it perfectly. It was the economic peak, securing maximum valuation.
The very IPO day, a Bear Stearns fund collapsed. 1 month later, the subprime crisis engulfed US and Europe.
All right, that's Blackstone's IPO story and the book's key content. Controversy always surrounded Blackstone and LBOs. Media public called them wealth plunderers.
they prioritize short-term gains through asset sales, factory closures, layoffs, harming companies and economies long-term.
Oh, buyout giants obviously disagree with that view. They stress their interventions improved operations, like Blackstone claiming 2/3 of acquisition profits come from company growth. The author argues while buyout firms exaggerate, leveraged buyouts do offer real business benefits.
First, they force cost cuts and boost capital efficiency.
After acquisitions, executives can't splurge. Perks get slashed hard.
Second, during recessions, LBOs grab bargains but also provide crucial funding.
Lastly, their financial expertise aids restructuring, M&A, and expansion. Today, Blackstone manages $580 billion globally. Its market cap even surpassed Goldman and Morgan Stanley, cementing its Wall Street titan status. Blackstone's investment philosophy, internal collaboration, and talent strategies offer valuable lessons. Notably, Schwarzman has a Chinese name, Su Shiman. In 2013, he personally donated $100 million to Tsinghua University for scholarships supporting global students. By 2016, this evolved into Tsinghua's Schwarzman Scholars Program. Okay, that wraps up King of Capital. Find notes below. See you next time.